Hey credit warriors, today we are going to be looking at the differences between credit cards and charge cards and some of the pros and cons of that. And this was actually suggested by one of our viewers, so I thought, hey, might as well do it. Well, currently the only issuer of general use charge cards in the United States is American Express, okay? All the others have been resigned to the history books, as to say. There are some stores that issue store cards that are charge cards rather than credit cards. You have to pay them off every month, but they're just for use in that store. They do not carry the logo of Visa, MasterCard, Amex, or whatever. So American Express is actually the only issuer of general purpose charge cards. So how does a credit card and a charge card, what's the difference between them? Well, let's first talk about payments and credit limits. So the way a credit card works is that you spend money on it, and you then, at the end of the month, you get a bill, and you have typically around 21 days to pay that bill, okay, until your due date. So when you get to the due date, you have to at least pay the minimum payment, which is normally at least $25 or a percentage. If you owe a lot of money, it changes to a percentage. If you owe several $1,000s, it could be like, $100 or something. So you have to at least pay the minimum payment, and then if you don't pay the rest, that gets rolled over to the next month, and it's charged interest on it, typically at a rate of around 20%. APRs range from about 15 to 25%. So you're getting charged a 20% also annual interest rate on that money that you don't pay off, as long as you pay the minimum payment. And if you don't pay even the minimum payment, then you'll get hit with a late payment fee. Now, on a charge card, it's the same. You spend money on it, and at the end of the month, you are sent a bill, or a bill is generated online on the website, and you have to pay that bill. And you have the same, you typically have around 21 days or so until the due date when the bill is due, but you have to pay it in full. If you don't pay the whole bill, all right, even if you pay, say, 95% of it and just a little bit you don't pay, you'll get hit with a late payment fee. Now, with American Express, their late payment fee, it's $27. And if you pay late twice within a 6-month period, it goes up to $38. So you get hit with quite a large late payment fee, even if you only miss, say, $1 of a $1,000 payment. If you pay $999 and just miss $1, you'll still have to pay $38. Now, Amex has introduced some payment plan options for large purchases, okay, called pay over time. So it has been experimenting with credit card style stuff on its charge cards, kind of a hybrid plan. I guess they're finding some way to compete when there aren't many other charge cards around, and they want to stay relevant and give people more options and compete with other issuers, right? So they do have some options on their charge cards to pay over time, but typically the basics of a charge card are you spend money on it and you pay it in full at the end of the month. So what about the credit limits on these cards? Well, with credit cards, they have credit limits, okay? And these credit limits, normally each card, each issuer's cards will have minimum credit limits. For example, Capital One Platinum, minimum credit limit is $200. Chase Sapphire Reserve, minimum credit limit is $10,000, okay? So you will be given, if you qualify, if your credit score and income are high enough, and you qualify for the card, you will be given a minimum, let's say for the Sapphire Reserve, you're given a minimum of $10,000 credit limit. If your credit score and your income is higher, maybe they give you 15 or 20,000, or they'll first give you the 10,000, then over time, as they see you're always paying off on time, they'll raise your credit limit, okay? Now with a charge card, it works differently. There's no preset spending limit. And notice they don't call it a credit limit, they call it a spending limit, and it's not preset. Now, Amex doesn't publicly say how they work it out, but bloggers and people kind of in the know, there's a general consensus that basically they work it out like this. The spending limit would be 3 times your highest balance that you have paid off in full over the most recent 6-month period, okay? So in 6 months, let's say your highest balance was $2,000, but you didn't pay it in full, so then they would go to your next balance that you did pay in full, say $1,800, and they would times that by 3, which would get you to $5,400, and that would be your spending limit. And then let's say if another month you spent $3,000 on your card, your Amex charge card, and you paid it all off, then they would increase your spending limit to $6,000, because that's 3 times the highest balance in that 6-month, most recent 6-month period. So that's how it is believed that it's worked out. Obviously, these algorithms are generally kind of kept secret and sometimes change as well, but that's kind of the current consensus on it. So no preset spending limit does not mean that there isn't a limit. There is. Amex does have, though, a tool on its website that you can use to see if a purchase will go through, all right? So you can use this tool and you can type in an amount and it'll tell you if it'll go through or not. Now, I don't recommend you just testing this tool, going higher and higher and higher to see where your spending limit is at, okay? Don't like start at 5,000 and go 6,000, 7,000, test again, because Amex looks at this kind of behavior and will get suspicious of you, okay? And, you know, it could trigger a financial review or something like that. So just be careful with this tool, okay? Only use it if you actually genuinely have a purchase that you want to make and you want to see if the purchase will go through, okay? Now, if you do want to make a very large purchase on an Amex charge card that is over your spending limit and is over the limit that you have, you know, used the tool to find, you can actually call them up, and usually if you provide proof of funds, they will actually pre-approve that purchase. And I have a friend who, he wanted to buy $45,000 worth of gold bars on an Amex Gold card, okay? Don't ask why, okay? It was an investment, but he wanted to get points from his purchase. And even though the gold dealer had told him that there was an extra fee, a small percentage fee for credit cards, he'd worked out that the points that he would earn would actually still, you know, be more valuable than the fee for booking business class flights. Okay, he had a business class flight he wanted to book, and the figures all added up. So he did it. He basically phoned them up and asked if it would be approved. I can't remember whether he needed to provide proof of funds or not. They might have just approved him. But anyway, he got the authorization for it, and his purchase of $45,000 worth of gold bars went through on the Amex Gold Premier Rewards card. Okay, now let's get on to how charge cards and credit cards affect your credit score differently, and then we'll also lastly be talking about some of the pros and cons of these two types of cards. So on your credit report, there can basically be three different types of credit accounts. Revolving accounts, which are basically credit cards, which will report a maximum credit limit and will also report the amount of money that you have spent out of that limit. So they report utilization. You'll get a percentage. You know, if your limit's $1,000 and you spend $300, then you're at 30%, okay? And that utilization, if it goes up, it can adversely affect your credit score. If it goes down, it have a positive effect. And they also report on-time payments. Then we have installment credit accounts, which is like mortgages and car loan payments or any type of loan where you have to pay a fixed amount each month, okay? And these generally will report on your credit report, and obviously they'll report negatively if you pay late, but the amount is fixed each month. Then lastly, we have open accounts, open credit accounts, which is things like phone bills, electricity bills, when you are signed on to a certain service, and however much of that service you use each month, your payment will be calculated, and it'll change from month to month. And, you know, charge cards also count as open credit accounts. However much you charge to one, that's the amount that you're going to get billed for that month, and it'll go up and down from month to month. And they'll also report on-time payments, but they do not report a maximum credit limit, so they don't report utilization. Now this has its advantages. So if you want to put a massive charge on a charge card, like my friend with the $45,000 worth of gold, or, you know, let's take it back down to earth, if you're just buying, say, a $3,000 business plane ticket and your credit limit on your credit card is $5,000. If you charged it to a credit card, you'd be at 60% utilization. That's bad for your credit score. So if you charge it to a charge card, because it doesn't report a credit limit, it doesn't report utilization. So it can't look like the card is maxed out. That it won't adversely affect your credit score if you put a large charge on a charge card, okay? Even if you think, oh, I've worked out my preset spending limit is this much, no, that doesn't count because it doesn't report that to the credit bureaus. It's not reported, so it just looks like a open account. Now, there is a con to this, and in some cases, when you're applying for a mortgage or a car loan or whatever, the Amex charge cards can appear as if they are just some other kind of open account, and it can appear like you have to pay that amount every month. So when loan brokers or mortgage originators are working out you know, how much of a loan you can afford, it may look like a monthly payment that you have to make every month. Now, one mortgage originator told me that this is the case, and one told me that this isn't the case. So, you know, it may or may not be the case. It could be just certain companies sometimes get tripped up by this, some don't. So to be maximally careful about things, I would suggest just zero out any Amex charge cards before you make a big loan application, okay? Or else you may have to just explain to them, oh, this isn't a monthly payment, it's an Amex charge card, I don't have to make that payment every month. So yeah, that's basically what I know about that. So that's how it affects your credit score differently. You don't need to worry about putting large charges onto your charge cards. That won't have an adverse effect, but you can worry about it when you're applying for other types of loans. There may be some impact on what you can afford, although some people say that's not the case, but we'll just be safe with it. Now let's just talk about what would be right for who. Well, charge cards, basically the pros are that they can encourage better financial responsibility because you know that you have to pay it back at the end of the month. So people generally do not spend as irresponsibly on them because they know they have to pay it back. Whereas credit cards do give you this flexibility that if in general you spend responsibly, but then you have one bad month, let's say you're self-employed, you don't have any clients that month, you could use a credit card just to get yourself through hard times and then next month pay it back. Credit cards are more flexible. Charge cards, you have to pay them off every month. I think charge cards are good for businesses because businesses, obviously if they're doing well, they do expect to have positive cash flow, but businesses will also generally have access to business lines of credit from the bank, which are kind of like credit lines that are much lower interest rates than credit cards. And let's say you use a charge card for your business's purchases, but you can then draw on your business line of credit, transfer that money into your account, and then use that to pay the charge card. And then your debt, your loan, is with the bank, not with the card. And the loan with the bank will be at a much lower interest rate than it would be on a credit card. It'd be like 5% versus 20%. So, for businesses, and also with Amex, they have developed a lot of features on their business charge cards that are really, quite good for businesses. So businesses benefit from them. Amex charge cards, like the Amex Platinum, have really good perks and lounge access and all that kind of stuff. So it's great for people who are going to put expensive plane tickets on the card, who don't want to worry about maxing out their cards. And especially good for people who are, say, business travelers who they put a $5,000 business class ticket on the card and then their company pays them back and they're able to pay it off immediately. That's the ideal situation, Credit cards definitely are going to be better for people who are less secure financially, who want to sort of at times may need to borrow a little bit on their card. I don't recommend borrowing on cards because the APR is so high, but sometimes you hit on hard times and you have to do it. There's no choice, right? So yeah, guys, that's basically the rundown on some of the key differences between credit cards and charge cards. Some charge cards do provide the best perks, like obviously the Amex Platinum with access to the Centurion Lounge, all that kind of stuff. But high class, high end credit cards do also offer a significant array of perks like the Sapphire Reserve, City Prestige, etc. So there are credit cards and charge cards competing in the space, but generally charge cards will have slightly better perks, I think, especially the high-end ones. Leave your comments below, guys. Let me know what you think about this, and if there are some points that I've missed, I would also love to hear your input and opinions on that. As always, please subscribe for new credit card tips and tricks almost every day, and we will see you next time. Bye-bye.